audio is for informational and educational purposes only and is not financial advice. Always do your own research before making financial decisions. Welcome, everybody. Today we're going to be covering a major development out of Washington. Lawmakers are reportedly moving closer to a stablecoin agreement tied to the Clarity Act. This bill could shape how digital assets are regulated in the United States. This isn't just a niche policy update. This bill directly impacts how stablecoins operate, how institutions interact with crypto, and how networks like XRP fit into the broader financial system. So we're going to break this down step by step, what changed, why it matters, and how different parts of the market are interpreting it. So what just happened here? According to recent reporting, negotiators have made progress toward resolving one of the biggest sticking points in the bill, stablecoin rewards and yield. Up until now, there's been a major divide over whether stablecoins should be allowed to function like interest-bearing accounts. The latest developments suggest a compromise is forming. Here we have Watcher Guru posting this. Looks like senators and Washington have struck an agreement here. So this is what's forming. We have stablecoins may be allowed to offer incentives, but those incentives would likely be restricted in structure, and most importantly, tied to active usage, not passive holding. I think that's the main thing there. So instead of earning simply by holding a stablecoin, rewards would be linked to using it, sending payments, interacting with platforms, or participating in on-chain activity. A lot of exchanges already kind of do this, like Uphold, and I think Coinbase might have some things. So that distinction is central to the entire agreement. So why was this such a big issue? This wasn't just a minor disagreement, right? It was one of the main reasons progress on the Clarity Act slowed down. Almost seemed like it was getting just completely pulled for a second a few weeks ago. On one side, you had crypto companies and blockchain advocates arguing that stablecoins are foundational to digital finance. Incentives help drive adoption, and restricting functionality too much could limit innovation. Then on the other side, traditional financial institutions, the banks, they raised concerns that yield-bearing stablecoins could compete directly with bank deposits, that users might move funds out of banks into digital assets, and that could have implications for liquidity within the traditional system. Because of that, the debate wasn't just about crypto, it was about the relationship between crypto and the existing financial system, aka the banks are terrified of crypto. That's why it took time to find some middle ground here. So breaking down the compromise, the solution being discussed introduces a clear separation between how stablecoins are held versus how they're used. Under this framework, passive holders would not receive yield. Active participants, those using stablecoins in transactions or applications, could receive incentives. So, it's another way of saying we're going to get what we want, right? This approach attempts to strike a balance by limiting direct competition with traditional savings products while still allowing stablecoins to function within digital ecosystems. It's not a perfect solution for either side, but it's workable, and in legislation, workable often matters more than perfect. So how will markets tend to view this? So far, we haven't seen anything quite yet, but let's see the market digest this and see what moves we have coming here. From a market perspective, developments like this are usually interpreted through a broader lens. So it's not just about the details of the rule, it's about what it signals. And what this signals is progress instead of delay, alignment instead of gridlock, and movement toward a defined regulatory framework. Markets tend to respond to clarity over time. All right, it's not going to be right away. So even incremental steps toward clear rules can influence institutional confidence, capital allocation decisions, and long-term positioning. For XRP specifically, why does this matter? So for XRP, XRP is designed around fast settlement, right? Cross-border payments and liquidity bridging. So when you introduce a framework that encourages active use of digital assets, that naturally highlights systems built for transaction efficiency. If incentives are tied to usage, sending value, moving liquidity, facilitating payments, then networks optimized for those functions become more relevant within that environment. This doesn't mean immediate price impact, but it does reinforce the role of utility-driven assets in a regulated framework. So the bigger picture, the Clarity Act. The Clarity Act itself is designed to bring structure to the digital asset space in the U.S. So that includes defining regulatory jurisdiction, clarifying how assets are categorized, establishing rules for market participation. Stablecoins are a major component of this system. So if stablecoin rules are resolved, it removes one of the largest uncertainties holding the broader framework back. That's why today's development is being watched closely. It's not just about one piece, it's about unlocking progress across the entire bill. So it's not all clear yet, right? We still have some uncertainties. Even with this progress, there's still some open questions. Some policymakers remain cautious about a few things like consumer protections, systemic risks, and how quickly digital asset usage could scale. I know Patrick Witt came out and was talking about how this was the main thing, right? Just getting the yield thing settled. Once that thing got done, then all these other issues were just gonna, get done very, very quickly. So it looks like we're gonna be pretty solid here. Maybe in the next week, we'll see. So at the same time, traditional institutions are still evaluating how these rules might affect their position. While direction is improving, the outcome isn't finalized, right? So what sounds out right now is movement. After weeks of uncertainty, negotiations are progressing, compromises are forming, and structure is starting to take shape, finally. So in markets, again, clarity, even gradual clarity, tends to matter. So we'll see how this shapes out. We're going to have more, so just, please like, subscribe. I'm going to be keep updating you guys here. If you found this helpful, please subscribe for daily updates. Thanks for watching, and I'll see you in the next one. Thank you.